Your 401k is about to buy a rocket company that loses $4 billion a quarter. You didn't approve it, you didn't vote on it, you can't opt out. And the rules that made this possible were rewritten 3 weeks ago. On May 1st, 2026, Nasdaq quietly executed the most consequential rewrite of its index methodology in a generation. The 10% minimum free float requirement, gone. The traditional 3-month seasoning period, gone. In their place, a single new mechanism called fast entry. 15 trading days after a mega cap IPO, the stock gets force-fed into the Nasdaq 100. No waiting, no price discovery, no questions. The first beneficiary? SpaceX. Ticker SPCX. Target valuation $1.75 trillion. Debut date June 12th. And here's the part nobody's saying out loud. George Noble, a 30-year veteran fund manager, called it on day one. Quote, "This is the most shameless structural manipulation of a major index I've ever seen." He's not wrong. Let me show you the machine. Start with the float. SpaceX is selling just 3.75% of its company to the public. At a $1.75 trillion valuation, that's roughly $65.6 billion of actually tradable stock. Of that, Goldman Sachs has earmarked 30% for retail investors, a kind of carnival sideshow to generate hype. That leaves roughly $45.9 billion of float for everyone else, including, critically, the passive index funds. Now here's where the new rules turn into a wrecking ball. Under Nasdaq's old methodology, SpaceX's 3.75% float would have disqualified it from the index entirely. Too illiquid, too dangerous for retail. So Nasdaq abolished the rule and replaced it with a sliding scale multiplier. If a stock's free float is below 33.33%, Nasdaq now calculates its index weight using up to 3 times its actual float adjusted market cap. 3 times. Let that sit for a second. SpaceX's real tradable market cap is about $87.5 billion. But for index purposes, it's treated as $262.5 billion. Against the Nasdaq 100 totaling $39.3 trillion, that artificial weighting drops SpaceX in at roughly 0.7% of the index on day 15, the 25th largest holding. Instantly, next to Costco, next to PepsiCo, companies that took decades to earn their spot. SpaceX gets there in 15 trading days. Now multiply this across passive AUM. The Invesco QQQ alone holds about $300 billion. The broader Nasdaq 100 family, over $800 billion. At a 0.7% weight, those funds are legally obligated to buy roughly $5.6 billion of SPCX in a 5-day window before the July 6th edition date. And that's just Nasdaq. The S&P Dow Jones Indices ran a parallel consultation that closed May 28th, with implementation proposed for June 8th, proposing to halve the seasoning period and waive the GAAP profitability requirement entirely for companies over $200 billion in market cap. If S&P follows through, and the entire $24 trillion S&P 500 universe gets pulled in, a modest 0.5% weight forces $120 billion of additional mandated buying. Total mandated demand, about $125.6 billion. Total available float, $65.6 billion. Demand exceeds supply by nearly 2 to 1. That isn't an investment. That's a structural short squeeze engineered before the first share ever trades. And now meet the company on the receiving end of all that forced capital. SpaceX's S1 filing, dated May 20th, reveals a GAAP net loss of $4.28 billion in the first quarter of 2026 alone. The 2025 full-year loss, $4.94 billion. Accumulated deficit, $41.3 billion. Total 2025 revenue, $18.67 billion. Of that, $11.4 billion came from Starlink, meaning 61% of SpaceX is, fundamentally, a satellite internet ISP. The crown jewel rocket business is barely a third of the top line. Then there's xAI, Musk's artificial intelligence startup, folded into SpaceX in early 2026 at a $250 billion valuation. It's currently burning $2.5 billion per quarter on GPU infrastructure, and the S1 reveals something else. SpaceX spent $131 million buying Tesla Cybertrucks at full retail price as ground support vehicles. It spent another $150 million advertising Starlink on X, Elon Musk's social media company. Translation: public IPO capital is being routed through SpaceX to prop up Musk's other failing ventures, and passive index funds are legally required to fund the pipeline. Then there's the lockup mechanic, and this is the most surgical piece of the engineering. Standard IPOs use a 180-day insider lockup. SpaceX uses a staggered schedule. Tranches release at 70, 90, 105, 120, and 135 days, with another 28% unlocked after the Q3 earnings report and the rest at 180. Because index weights are float adjusted, every time insiders dump a new batch onto the market, the float expands, which forces the index providers to recalculate, which forces the passive funds to buy more. It's a guaranteed bid at every exit door. Insiders sell, index funds catch the falling shares. Repeat. Jacob Friedman, the analyst at Investment News who first decoded this, put it plainly. Depending on how aggressively insiders sell into the early release windows, SpaceX's float could expand meaningfully before inclusion, which would push its weight higher and force index funds to buy even more. The result is a perpetual motion machine, insider liquidity guaranteed, passive demand guaranteed, price support guaranteed, and the man at the top of it controls 85% of the voting power, despite owning just 42% of the equity. Musk reincorporated SpaceX in Texas specifically to strip public shareholders of basic proxy voting rights. CalPERS, the $450 billion California pension, and the New York State Common Retirement Fund filed formal challenges on May 15th to his unfireable CEO provision. They will almost certainly lose. The IPO is already calendared. And on May 26th, the U.S. Space Force handed SpaceX a $2.29 billion fixed-price contract for the Space Data Network backbone, perfectly timed to juice the roadshow. Roadshow launches June 4th, pricing June 11th, trading June 12th, forced index inclusion July 6th. The clock is already running, so zoom out. What does this actually mean? The American pension is dead. In its place, 401ks, IRAs, target date funds, overwhelmingly passive, overwhelmingly indexed. Over 50% of U.S. equity assets are now managed by funds that don't analyze companies. They just buy what the index tells them to buy, which means the index providers, Nasdaq, S&P, FTSE Russell, have quietly become the most powerful capital allocators in human history, and they just spent May rewriting the rulebook to accommodate one company. The same playbook is already being prepared for OpenAI, targeting an $852 billion valuation, and Anthropic, and whoever comes next. Public stock markets used to be where companies came after they proved themselves. Now they're where Silicon Valley insiders come to exit. And the exit liquidity isn't pension funds making informed choices. It's autopilot. It's your monthly paycheck contribution. It's the dentist in Cleveland who picked the S&P 500 index fund in her 401k because someone told her it was the safe option. She's about to own a piece of a rocket company that loses $4 billion a quarter. She'll never know she bought it. She'll never have a chance to say no. And somewhere above her, in low Earth orbit, another Starlink satellite quietly switches on.